Podcasting is the secret to success in VC. Carta launches a private stock exchange, and usage-based pricing is the new gold standard in SaaS. That and more on this week's PLG123. Let's dive in. Tab 1. Tab 1 is from TechCrunch and is about the new VC fund from podcaster Harry Stebbings. So here's what happened. Harry Stebbings is the brains behind the very popular podcast, The 20-Minute VC. It's one of the top podcasts out there for VCs and founders, and every episode is great. And besides the podcast being great, Harry's own story is great as well. This tweet sums it up. He started the podcast 6 years ago, back when he was 18. And as this tweet points to, he didn't have a lot to offer other than his curiosity and ambition. But it looks like those were exactly the right ingredients for success, because today he's now recorded over 2,500 episodes, received more than 80 million downloads, and has had world-class guests on like Stuart Butterfield, Reid Hoffman, and Chamath Palihapitiya, among many others. So now on to the fund. Harry's calling it the 20 VC Fund, and he's now raised $8.3 million to make investments about $250,000 a pop into companies alongside top-tier investors like Sequoia, Index, and many others. The capital he's raised so far comes from 83 individual investors, and many of them are GPs at top funds like Danny Reimer at Index, Joshua Kushner at Thrive, and David Sachs at Kraft. So here's why this matters. Clearly, podcasting is becoming a powerful and maturing medium for journalism, entertainment, and personal branding as well. Perhaps to state some obvious examples, we've seen things like Joe Rogan's $100 million deal from Spotify. We've also seen Spotify acquire podcasting networks like Gimlet Media, and Amazon also acquired one called Wondery very recently. And in the VC world, there's no shortage of VCs with great podcasts. For example, the A16Z podcast isn't just a great VC podcast, it's also regularly at the top charts, indicating that it's dramatically expanded outside of the industry itself and garnered a much wider audience. But I think that Harry's story is a first, with a podcaster raising a VC fund off of the back of the podcast itself in terms of the reach and the access that it gives him to some of the best deals in the market. So here's what to keep your eye on going forward. Knowing Harry, I'm sure he's going to continue to make great investments, so keep an eye on his growing portfolio. And who's the next podcaster to raise a VC fund? And will we see this carry over to creators on other growing platforms like Substack, Clubhouse, and others? Tab 2. Tab 2 is from Carta and is about their huge new launch, Carta X. So here's what happened. Carta is a widely known and widely used product in the VC and startup community. It's an elegant solution for an annoyingly complex task: ownership and cap table management. And off of this initial entry point, the company has introduced many complementary offerings, like 409A valuation services, managing data rooms, managing board business and board consents, the list goes on. And all of this has been an impressive and steady march towards Carta's long-term vision. And what is that long-term vision? Well, CEO Henry Ward puts it well here in the accompanying Medium post. The second sentence of the post sums it all up. He says that in 2013, they raised their seed round on the pitch of building the NASDAQ for private markets. So that's the long-term vision. So here's the basic logic behind that vision. If you're in a position like Carta, where you're managing the ownership of that company, and you're managing the valuations of that company and the board business of that company, it gives you a pretty good entree into facilitating transactions for the equity that you're managing of those companies. Specifically creating a two-sided marketplace of folks who hold equity and want to sell it, and folks who have capital and want to buy equity. And a marketplace of securities exchanged for dollars is a stock market, thus the NASDAQ analogy. So in terms of this two-sided marketplace or stock exchange, on the supply side, Carta's been emphasizing that for the last 8 years. That's what they've been building. But the demand side of the marketplace is newer to them. But it looks like they're making pretty impressive progress towards that, with this reference to 53 institutional investors on Carta X, all competing to get access to these companies. And it looks like day one for Carta X was quite successful, with a lot of liquidity being generated in the marketplace, almost $100 million across almost 1,500 transactions. So they're off to the races with a bang. So here's why this matters. This specific vision of the NASDAQ for private markets is just a component of a much longer term vision, which is described as a multi-decade march towards rebuilding the world's financial system. Carta X is initially targeted at secondary transactions as a replacement for tender offers. But the CEO points to plans to use Carta X to facilitate primary capital raises as well. I think the logic behind this is back to the two-sided marketplace, is that today there's more supply than there is demand, but as that demand eats up that initial supply of secondary shares from employees, there's going to be a world in which there's more demand or more capital than there are shares available, which will put the companies in a position to offer up new shares, aka a capital raise, to those investors who have lots of capital and lots of demand to get into these businesses. So here's what to keep your eye on going forward. The VC space has seen a lot of innovation in recent years, but a lot of that innovation has taken place at the other end of the spectrum, the very early stage end of the spectrum, with examples like AngelList and Y Combinator, both of whom are driving innovation and standardization for early stage companies. But the Carta X example is at the other end of the spectrum with late stage financings. So we have this kind of barbelled approach with innovation at the early stage and now some innovation at the late stage, and it leads to the question of, will the entire VC industry and capital raising process be revolutionized and changed? Tab 3. Tab 3 is from TechCrunch and underscores the rise of usage-based pricing in the software industry. So here's what happened. My colleague Kyle Poyar here at OpenView wrote this article and made a pretty bold claim that subscription-based pricing is dead, and it's being replaced by usage-based pricing, which is the future of software. Now, it's important to know when we talk about subscription-based pricing, it means the old school version of subscription-based pricing, where you kind of buy a handful of seats and that's what you're gonna pay, a fixed price per seat for the next 12 months. And then at the end of the 12 months, we'll renegotiate and figure out what next year is going to look like. And with usage-based pricing, we're talking about a value metric that probably isn't seats and is pegged to the actual usage of the product, which may be much more variable than a fixed number of seats over a 12-month period of time. And the best example of this is probably AWS, where you can consume its services for as small an increment as half a penny per hour. So usage-based pricing really started and has been perfected at the plumbing layer of SaaS. And we've now seen adoption and success all the way up to the application layer for usage-based pricing. So here's why this matters. Usage-based pricing isn't just growing in popularity, it's also correlated with much greater success than subscription-based pricing. And this comes through very strongly with public companies like Shopify, Snowflake, Datadog, and many others. And this scorecard, which compares all public SaaS companies, shows that usage-based pricing helps you outperform on virtually every metric that matters to a SaaS business. Whether it's growing nearly 40% faster in terms of revenue growth, better growth efficiency on the Rule of 40 metric with an 8-point advantage towards usage-based pricing, or perhaps the all-important metric of valuation, with a 50% higher multiple attributed to usage-based pricing. And zooming into net retention specifically, this chart shows recent IPOs with the best net retention. You see that the vast majority of best net retainers leverage usage-based pricing. That's the dark blue bars versus the green bars. In fact, within the top 10, 70% of them leverage usage-based pricing, with only Smartsheet, Zoom, and CrowdStrike leveraging a traditional subscription model. And spoiler alert, even Zoom uses a usage-based limit to drive conversion on their per-seat pricing, that 40-minute limit on a free Zoom. So even Zoom is a little bit of a hybrid. I think the SaaS world is going to continue to standardize on usage-based pricing. However, if you're looking to move to usage-based pricing yourself, it can be a little bit of a challenge. Some have compared it to a change on order of going from on-prem to the cloud for the very first time. So in other words, not just a simple switch that you flip. Unlike seat-based pricing, which is a pretty standard metric regardless of the product you're selling, a usage-based value metric is much more bespoke and custom to your actual product, so it takes more work to figure out what that should be. And there are many other downstream implications, from the billing system that you use to sales compensation plans and how those may be impacted. The list goes on. But thankfully, my colleagues Kyle and Sanjeev have put together a usage-based pricing playbook that's 60 pages long that answers all of these questions. So go check it out and see how your company can embrace this powerful pricing strategy. Well, that does it for this week on the PLG123. Make sure to follow me on LinkedIn for more daily PLG content, and stay tuned for our weekly episode drops at the PLG123 coming at you right here on LinkedIn. Hope you all are having a great week, and take care.